The global energy market is currently navigating the largest oil supply disruption in history, centered on a critical maritime choke point. The Strait of Hormuz typically carries 1/5 of the world's oil and natural gas. With traffic restricted, governments have been forced to tap emergency reserves and implement energy-saving measures to manage the supply gap. On Friday, April 24, 2026, the diplomatic gridlock showed its first sign of movement. The White House confirmed direct peace negotiations are resuming. Press Secretary Carolyn Leavitt announced that U.S. Special Envoys Steve Witkoff and Jared Kushner are traveling to participate in these direct talks. Shortly after, Iran's Foreign Minister, Abbas Araghchi, signaled his own delegation's travel, creating a rare moment of diplomatic convergence. The destination for these high-stakes sessions is Islamabad, Pakistan. For emerging market investors, the confirmation of the Islamabad summit provided a tangible diplomatic anchor, triggering an immediate repricing of global risk. This chart tracks Friday's immediate reaction in energy markets. Brent crude futures fell to $104.83 per barrel. West Texas Intermediate retreated to $93.90, as markets priced in a lower probability of supply disruption. Thousands of miles away, the South African rand strengthened in direct response. This suggests that South African financial markets are currently functioning as a highly sensitive proxy for Middle Eastern geopolitical stability. Because South Africa is a net energy importer, the risk premium in the Strait of Hormuz is mathematically coupled to the Reserve Bank's inflation calculus. We can trace this exact transmission mechanism, showing how a choke point standoff impacts everything from transport inflation to the yield on sovereign bonds. Prior to the Friday breakthrough, the oil market was characterized by a massive geopolitical risk premium. This pressure was driven by Iranian vessel seizures and the total absence of a confirmed framework for negotiations. Even when an initial ceasefire was announced earlier this month, exports from Middle East Gulf producers remained collapsed. Markets remained high because shippers still faced an unresolved security environment, which kept tanker traffic through the strait severely restricted. President Trump even prolonged after a second round of talks fell apart, citing what he described as fractured Iranian leadership. Until delegations were physically moving toward a table, the market refused to remove the risk premium, making the Islamabad travel confirmation a material change in posture. To see how this hits the economy, we start with South Africa's foundational vulnerability: energy dependency. South Africa imports the vast majority of its crude oil. Every dollar added to the price of Brent translates into tangible, imported inflation, primarily through higher fuel costs. This transport inflation eventually bleeds into the broader economy, raising the cost of moving goods and impacting base consumer prices. On Wednesday, as talks stalled and oil climbed, we saw the rand weaken to 16.53 against the dollar. This currency depreciation creates a compounding loop, making imported oil even more expensive in local currency terms. This dynamic forces the South African Reserve Bank into a defensive posture, moving the impact from consumer inflation directly into the sovereign bond market. The ultimate casualty of this imported inflation is South Africa's benchmark 2035 government bond. On Wednesday, the 2035 bond weakened, with its yield rising 6 basis points to 8.615%. Bond prices and yields have an inverse relationship. When prices weaken, yields must rise. This happens because bondholders anticipate that the Reserve Bank will be forced to hike interest rates to combat oil inflation and defend the currency. To attract capital under the threat of rate hikes and devaluation, the bond must offer a higher compensatory yield to investors. Friday's confirmation of the Islamabad summit instantly rewrote this entire pessimistic calculus. As the oil premium vanished, the immediate pressure on the Reserve Bank lifted, allowing the rand to recover and bond yields to stabilize. Historical precedent shows the scale of this link. When the ceasefire was announced earlier this month, the JSE All-Share Index surged over 5%. During that same period, the rand strengthened more than 2.3% against the dollar. These swings show how closely South African financial assets track the security of the Hormuz corridor. However, financial markets are currently pricing in the probability of a solution, rather than a guaranteed outcome. This confidence fueled a selective U.S. rally, with the S&P 500 advancing 0.7% and the Nasdaq gaining 1.5%. Winners concentrated in sectors insulated from energy costs. Intel surged 19%, and Nvidia crossed the $5 trillion market cap threshold. But consumer data released on the same day offered a sobering counterweight to the equity rally. The University of Michigan's sentiment gauge hit a record low of 49.8 in April. This figure is down 6.6% from the previous month and 4.6% below the same period last year. The divergence is clear. Equity markets are front-running diplomatic rumors, while consumer sentiment reflects the embedded damage of high fuel costs. One metric from the sentiment report is particularly critical. Long-term inflation expectations rose to a preliminary reading of 3.4%. For economic stability, policymakers need these inflation expectations to remain anchored. The U.S. Federal Reserve is watching this 3.4% figure closely ahead of its scheduled rate decision on April 29th. For South Africa and broader emerging markets, the current trajectory is constructive, but entirely contingent on the outcome in Pakistan. A productive Islamabad session that establishes a framework for reopening the strait would likely accelerate the rand's recovery and ease the Reserve Bank's inflation burden. Conversely, a breakdown in these talks would likely send Brent crude back above $110 per barrel. If diplomacy fails, the market will likely reprice risk assets for a sustained energy shock, leaving the valuation of South African bonds and energy futures tied to the specific progress made in Islamabad.